Hello, everyone. Welcome to my workshop. First of all, I would like to thank Mohammed for inviting me to present this workshop. Good morning, good afternoon, good evening, depending on where you are. I'm very excited to be here, and I look forward to your comments and suggestions. This is a relatively new paper, and I have already included the link to a paper posted on SSRN in the chat. So please feel free to download the paper, and if you have written comments for a paper, you're welcome to share your comments with us. I would like to acknowledge the invaluable contributions from my co-authors, Brooke Lev from NYU and Chen-Chi Zhu from UC Irvine. Without their collaborations, this paper would not be possible. I believe Chen-Chi is with us today. She's going to help us take notes and maybe help me respond to some of your questions. Please feel free to raise your questions anytime during my presentation. We're trying to follow the regular workshop format to have as much interaction as possible. So a few years ago, I co-authored a book with Brooke Lev, and the book is titled The End of Accounting and a Path Forward for Investors and Managers. As the book title suggests, this book is largely practitioner-oriented and it focuses on the idea of declining accounting relevance and how to fix it. After the book came out, we had opportunities to present it to many accountants, financial analysts, corporate executives, investor relations professionals, hedge fund managers, and other business practitioners. Quite surprisingly, among all the evidence that we presented to highlight how today's accounting information is very different from the accounting information 30 or 40 years ago, we received the strongest reaction to this graph from business practitioners. So this graph basically shows the growing frequency of and amount, both the frequency and amount of accounting losses reported by US public companies from 1950 until 2019. It's just difficult for practitioners to comprehend the continuous increase of loss reporting over time. So in 2019, which was the peak of a decade-long record-breaking economic boom, nearly half of all public companies in the US were reporting losses. To be exact, it's 46%. In the more vibrant and rapidly growing technology sectors, where lots of jobs and a substantial economic wealth are created, the loss frequency was even higher, standing at nearly 70% in 2019. The amount of loss relative to firms' total assets has also been increasing over time, reaching more than 20% for all loss firms and more than 40% for all technology loss firms in 2019. So most people looking at this graph were very surprised to see more and bigger losses during periods of strong and continuing economic growth and prosperity. They would not expect to see anything like this. A very similar trend also exists in UK and EU countries for both the frequency of loss reporting and the amount of losses relative to firms' total assets. So the continuing rise of loss reporting is a truly global phenomenon. Although most business practitioners were surprised by this large scale and a far-reaching phenomenon of loss reporting, we as accounting researchers are actually quite familiar with this phenomena from existing research on loss firms. So what do we know from existing research on loss firms? There's actually a sizable literature covering several important issues about loss firms. The more contemporary literature starts with Callahan's 1995 JE paper, which demonstrated that losses are less informative than profits. Her results show that there is basically no information in the reported losses. So that's the first study to document the phenomena of lack of information content in losses. Subsequent studies have found that increased R&D spending is an important contributor to the growing prevalence of losses. Some studies try to examine if losses are more informative when other accounting variables such as book value are included in the valuation models. And then they find some differences, but still they continue to document significantly lower information content for losses. For example, this study by Sifdesi and Darren in 2015, after comprehensive literature review and their own empirical examination, they pointed out that the fact remains that earnings still have low value relevance for loss firms compared to profit firms. So the valuation gap is still quite pretty large, no matter what we do in our valuation model. So by now, the lack of information content in losses seems a very robust result and has been taken for granted by accounting researchers for the last 25 years. For example, in many empirical studies, researchers typically include a dummy variable for loss firms. So if you follow this research methodology, that basically means nearly half of public firms in our sample would have a dummy variable because of their loss status. And then if you move to technology sectors, that would be 70% of firms would have this loss dummy variable. That's really not a great idea from research design standpoint. So many of the studies on loss firms, starting from Callahan's 1995 JE paper, conclude that the liquidation/abandonment option explains the missing information content for losses. In other words, they attribute the lack of information content for losses to this theory of liquidation abandonment option, which basically said that because investors will likely react to losses, particularly long-lasting and persistent losses, by liquidating these loss firms and then redeploying the liquidation funds elsewhere, losses are not expected to carry the same information about expected future cash flows and firm value for going concerns as profits. So that's the interpretation. That's at most of the time, it's the only interpretation for this very strong result. So supporting this liquidation-based interpretation, there is a paper by Pinnock and Lillis in 2007, the accounting review. They document the evidence showing that there are more employee layoffs at loss firms, which they interpret as a support for the liquidation option hypothesis. So this is pretty much everything we have learned so far from the loss literature. Okay, so because of the benchmarking importance of Callahan's 1995 JE paper, in this research, my co-authors and I began our thought process with a careful replication and extension of her key results. So this is table 4 from her paper, the 1995 JE paper. As you can see that in her sample, loss firms account for 19% of her sample firms. And she essentially showed that the ERCs, as well as adjusted R-squares for loss firms from the return earnings regression are substantially lower than those from the same regression for profitable firms. Okay, as a matter of fact, for loss firms, the ERC is close to 0 and adjusted R-square is essentially 0. All right, so that's for the level of losses. For the change of losses, results are somewhat better, but still they're much weaker than the results for profitable firms. Her results also demonstrate that for more persistent losses, the information content becomes smaller. So the more persistent losses become, the less informative the accounting earnings information would be. All right. So this is another important finding from her paper. So when we carefully replicated her study and her test, we essentially found a very similar results. So for the same sample period included in her study, which is from 1962 to 1990, Our regression results reported here are very close to hers, and we indeed confirm the lack of information content for losses. So nothing has really changed. It's a pretty robust finding, as I said earlier. However, when we extend our sample period to more recent decades, from 1990 to 2018, so all the decades after the sample period included in the Callahan study, when we did that, we actually saw a few interesting changes. For example, if you look at the overall sample, including all firms, going from the earlier sample period for the more recent sample period, we saw a substantial decline in the overall earnings relevance, measured by earnings response coefficient, as well as the adjusted R-squares. So this is consistent with the message from my book, as well as the findings from other research papers, showing a broad decline in the value relevance of earnings information for all firms. When we focus on loss firms, in terms of the information content for the level of losses, it's pretty much the same as before. There's not much change. It's pretty much flat, zero information content. For the change of losses, it's still much weaker than for profits, and it's also less informative than the early period. When we look at a profitable firm, same picture, there is a broad decline in the relevance of earnings. So overall, the loss picture for more recent decades looks sufficiently different from the picture of the earlier decades, and therefore deserve a closer examination. For example, in the more recent sample period, the percentage of loss firms accounts for 31%, about 60% higher than used to be during the early sample period. So this gives us enough reason to take the next step, because we believe the characteristics of loss firms have changed over time. So that's part of the motivation of our study. So given this extensive literature on loss firms and the phenomenon of loss reporting, the question is, what else can we bring to the table? So in this study, we bring a couple of new perspectives into the examination of loss firms. So basically, we distinguish between two very different types of loss firms. We call gap losers and real losers. And we do this by adjusting reported earnings for all internally generated investment in tangible assets, including R&D, brands, business processes, IT, human capital, etc. So that's our approach. So under our approach, gap losers are firms with negative reported earnings, but positive adjusted earnings. And real losers are firms for which reported earnings and adjusted earnings are both negative. So this adjustment essentially reverses the bias effect of expensing this internal investment intangibles and incorporate their capitalization and amortization effect into earnings. So to explain why we take this approach, I want to cover two issues. One is R&D and the other one is non-R&D intangibles. I believe the case for R&D is pretty straightforward. It has been, the capitalization and amortization for R&D has been implemented in many prior research, mostly using industry-specific amortization rates. So I don't think I need to provide a lot of justification here. We're basically following a very well-established prior research methodology. However, the case for SG&A is relatively different, and it's much more recent. That studies in economics, finance, and accounting that have incorporated SG&A in their capitalization, amortization of intangibles. And I think the case can be justified for more recent sample years, as over time, many firms have shifted their spending in this area to more intangible-driven areas, such as information technology and branding. So this example from Pfizer, a very well-known pharmaceutical company, shows clearly that the company is using a more informative title, selling information and administrative costs, instead of SG&A, for this expenditure to indicate its new focus on intangibles. And by the way, Pfizer's advertising expense accounts for 20% of its total selling information and administrative costs. The company even classifies brands, most likely acquired brands, as an indefinite-lived intangible assets, pretty much consistent with how economists view such assets. So using our methodology to classify loss firms, we define again GAAP losers as loss firms that report negative earnings but positive adjusted earnings under our approach. And the real losers are loss firms for which both reported earnings and adjusted earnings are negative. When we apply our methodology to our sample, we find that GAAP losers account for approximately 35% of our loss firms across all years. So a little bit more than 1/3 of our loss firms are classified as GAAP losers under our methodology. So here's an example. Here's a numerical example demonstrating the application of our methodology for classifying two software firms reporting losses. We follow prior research to use a 3-year R&D amortization schedule for both firms. You can see that both firm A and firm B report negative earnings under the current accounting standards. So for the first step, we take reported earnings, which are income before extraordinary items is given. And then we add back current year R&D expenditure. They both have R&D expenditure. We add back current year R&D expenditure, year T, and then we take into account the amortization expense of R&D over the last 3 years, T-1, T-2, and T-3. So that's the subtraction of amortization expense. We also capitalize 1/3 of SG&A expense, which is following the methodology that has been used in recent studies in economics and finance. We don't take everything from SG&A, we only capitalize 1/3 of it. So that helps us arrive at adjusted earnings. So for firm A, you start from negative earnings, negative reported earnings of $50 million. And after adjustment for intangibles, we come up with adjusted earnings of $26 million. So under a methodology, firm A is classified as a GAAP loser. Firm B, on the other hand, with the same adjustment, still has a negative adjusted earnings, negative $11 million. So firm B would be classified as a real loser under our methodology. So that's basically how we classify loss firms in our sample, okay? So I see a couple of chats, so let me just slow down and see if there's anything I need to respond. Okay, we're okay. Any questions so far? Okay, good. All right. So with this,
I have a real quick question.
Go ahead.
So 1/3 of SG&A is going to be an asset in perpetuity?
Yes.
So after many years, the asset side of the balance sheet is just going to keep growing and growing and growing, and this SG&A is indefinitely lived.
Under the current methodology, yes, that's we're not talking about the balance sheet. Okay, by the way, we're only interested in adjusting reported earnings, but
no, I understand. But if you take it out of earnings, it has to live somewhere, right? It's going to be on the balance sheet. So what's this do to our different measures of, like, say, return on asset, return on equity?
Yeah, it will.
Are we trying to make earnings, like, let's say, have a higher coefficient on the regression, but throwing away information that might be relative to managers' decisions or ability to face future consequences? That's my concern.
What type of information is being thrown out? Could you specify a little bit?
Well, yeah. So managers' decisions. Currently accounting only accounts for errors of commission and not errors of omission by definition. So if we're taking some of these losses or some of these expenses away, and we're going to start accounting for it this way, what does that do behaviorally to managers? Does that make them, if you will, want to start to reclassify things to SG&A or to R&D rather than put them as regular operating expenses? My concern is that if we change the measurement system, we are going to change managers' behaviors.
Well, I think your point is well taken. Definitely, managers' behavior is driven by current reporting system, and we do have a set of management behavior problems under the current reporting regime. For example, real earnings management is one of them. So, for example, if managers wants to increase earnings for a given period, they can spend less on R&D. They can spend less on SG&A. Without having to show any justification, automatically that's going to increase their earnings. However, if you capitalize R&D and SG&A, you would be able to take away a very effective weapon the managers has for inflating earnings, because under the capitalization regime, anything you can do to increase or decrease your R&D and SG&A spending in each given year is only going to have a much smaller impact on your earnings of that year. So there is always a trade-off. How this is going to affect the balance sheet information, it's not immediately in the scope of this paper, but if you're interested in some of the thoughts my co-author and I have developed over time, I mentioned this book at the beginning. We actually spent a lot of time looking at the trade-offs involved. So that's a much better source of information. So today's in my today's presentation, in this paper, I'm only going to focus on earnings because I'm going to show you the currently reported earnings for these firms are not informative. All right. So forget about the balance sheet for a moment. Earnings are not informative. I think that's a #1 problem for accounting, because we tell people earnings number is the bottom line information from the income statement. All right. And the balance sheet is not completely immune from this problem, because over time, the book value of equity has lost relevance as well. And a good example I can give you is the failure of value investing. When people rely on book value to make important investment decisions, they have found out over time that it's no longer working. It used to work pretty well. So from an investor standpoint, I think at this given moment, they actually have serious problems if we don't do anything. I'm not saying our approach is going to be perfect, but I think at least it's useful to start exploring options, because the status quo is definitely not going to work. As I was showing the graph of increasing loss reporting over time, I think we have a credibility problem. When people realize that, wow, more and more firms are reporting losses in a booming economy, what does that mean? It doesn't going to work well for accounting. So that would be my response. Okay, so we have some first order effect and maybe second order effect issue going on here. Okay, so here's a very quick summary of our main results from our empirical test. So using our methodology, we first re-examined the earnings relevance of loss firms by classifying all those firms into GAAP losers and real losers. And we find that the reported losses of GAAP losers are actually as informative as the reported earnings of profitable firms when internal intangible investments are considered as assets and included in commonly used valuation model. On the other hand, the reported losses of real losers are still not as informative. They're actually the least informative earnings information. So that's the first finding. In the second part of our paper, we try to shed some light on the validity of the liquidation option as the interpretation of the loss reporting phenomena. So we examined the relevance of liquidation option for each type of loss firms. Our results show that GAAP losers actually face no prospects of liquidation because these firms are more successful innovators and create more value from their investment in technologies and human capital than other firms. Definitely, they're doing better than real losers, and in many cases, they are even doing better than some of the profitable firms. So our results suggest that the liquidation option is not quite relevant for GAAP losers, about 1/3 of our loss firm sample. In the last part of our paper, we also examined the future performance of loss firms, again, following our methodology of classifying loss firms into GAAP losers and real losers. We find that GAAP losers are less likely to decline and are more likely to reverse their losses in future than real losers. So they're definitely doing better in the future. We also find that GAAP losers have better future stock performance than profitable firms, particularly over the last 20 years. So this is a very quick summary of our key results. Okay, so in terms of our potential contribution, I would like to point out a couple of key differences and their implications between our study and the prior literature. So first of all, we consider all internal intangible investment, not just R&D, as prior studies have done in this literature. So we're including non-R&D intangibles because intangible investment in brands, business processes, IT, and human capitals, collectively, they are larger by R&D expense by several times. It's not just a little bit larger, it's actually quite a lot. For example, for all firms, all CompuStat firms, for every $1 they spend on R&D, they're also spending $6.70 on SG&A, brand, IT, human capital, and so on. For the R&D intensive technology firms, for $1 of R&D they also spend $2.20 on non-R&D intangibles. So basically the investment in non-R&Ds are relevant for all firms. They're larger and not just relevant for technology firms. So that's why we include all of them together. And this is a very important difference. With this difference, we examine the complex effect of undoing the immediate expense of intangible investment on firms' loss status by classifying them into GAAP losses versus real losses. So that's another step we're taking to expand the prior literature. So with a new approach, we show that contrary to the widely accepted view that losses are less informative than profits, the reported losses of GAAP losers are actually as informative as the reported earnings of profitable firms. When we adjust for the capitalization and amortization of intangibles and include the adjustment in some commonly used valuation models. So that's a key difference. We show very different results. Okay, liquidation option. As I explained before, this is a very important part of the literature on loss reporting. So all evidence shows that this liquidation option hypothesis does not apply to GAAP losers. For GAAP losers, we find that persistent losses don't affect the earnings relevance of these firms. So we don't have the classic finding showing that more persistent losses have low earnings relevance. No, that doesn't work for GAAP losers. More importantly, as I mentioned earlier, GAAP losers actually don't face any prospects of liquidation. They're very successful in their innovation in intangibles. They develop more valuable patents, and they also receive much higher return on their investment in human capital. So that's a key difference between GAAP losers and real losers, and even some profitable firms. So at the last step, we also shed some light on the future performance of our loss firms, which is largely missing in prior literature on loss reporting, but actually quite relevant for understanding the implications of this huge increase in loss reporting over time. Last but not the least, we also classify loss firms differently. And this is very different from some of the existing approach in the prior literature. So for example, the study by Hose and Plasko, they classify loss firms into two categories, transitory loss versus persistent loss. So they implement their classification by using the probability distribution of future loss reversal. So firms in the top quartile of the distribution is classified as transitory losses because they're more likely to reverse losses in future. And the firms at the bottom quartile of the distribution is classified as transitory losses, persistent losses because they're least likely to reverse losses in future. However, they leave out the middle quartiles from their methodology, so their results, everything essentially don't cover half of their samples of loss firms. So our approach is completely different. Conceptually, we identify gap losses and real losses by looking at the effect of adjustment for intangibles on the status of reported losses versus adjusted earnings. So conceptually, that's very different from the existing approach. More importantly, we empirically confirm that our approach does not simply repeat what the earlier approach does. For example, when we replicate the studies by Holz and Plasko, we actually find a very limited overlap between our classification and their classification. For gap losers, the extent of overlap is no more than 20% relative to their classification of transitory losers. The early approach is also subject to the rising R&D spending because they find in their paper that the distinction between persistent losses and transitory losses have somehow been confounded by the rising R&D expenditure over time. This problem does not affect our approach because we simply, take everything into consideration. Okay, so first I'd like to just show some more details on the first part of a study examining the earnings relevance. All right. Before I get into details, let me just try to pause for a second and see if there are any questions. Okay. So there's a question here. Can this study be done for IFRS by using the context in India? I get presentation studies and understanding. Okay, I believe so. The accounting regimes are different. Under IFRS, some intangibles like R&D are capitalized, but they still leave out a lot of other internally generated intangible assets. So there's still room for improvement. So I believe you can implement the same methodology to firms subject to IFRS reporting. Okay. So next, I would like to show some more details about our examination of earnings relevance. Here's the descriptive statistics of our sample firms over the period of 1991 to 2018. So just very general statistics here. Profitable firms, for example, are much larger than loss firms, very consistent with the findings from early studies. Gap losers, interestingly, they have very similar market capitalization as real losers, not much difference here, okay? So that's the descriptive statistics. Again, gap losers account for about 35% of all loss firms. Okay, so when we run our annual regressions, year-by-year regressions, first, we look at earnings relevance for reported earnings, and this is simply a replication extension of prior research in this literature. We're including both the level and the change of reported earnings in the same regression in order to capture everything all together to give a comprehensive picture of earnings relevance. So as documented by prior research, the earnings relevance measured by the earnings response coefficients for profitable firms, always larger than loss firms. Loss firms, the level of earnings, the level of loss is essentially not informative. When we divide loss firms into gap losers and real losers, still it doesn't change the earlier findings showing the lack of information content for losses, all right? So that's basically a confirmation that we're capturing the same effect as prior research. However, when we replace reported earnings with adjusted earnings by following the earnings adjustment approach that I explained before, the results for some of the samples are very different, okay? Not a lot of change for profitable firms. If you look at earnings response coefficient, it was 0.31 under reported earnings. On adjusted earnings, it's 0.26, a very small and insignificant decrease, so nothing to worry about. However, for loss firms, we see quite a big of increase, a significant increase of earnings response coefficient from 0.14 to 0.2, statistically significant. And breaking down a sample to GAAP losers versus real losers, you can see that most of the changes, actually all of the improvement for loss firms come from GAAP losers, all right? So for GAAP losers, the earnings response coefficient under reported earnings is 0.31 versus 0.14 for reported earnings. So it has more than double, okay? For real losers, you see a little bit of increase. It's basically insignificant. So let's call there's no change. Okay, let's say there's just no change. So we provide a more statistical test here to find out whether or not the changes we have discovered are statistically significant. And we confirm a number of very important results. For example, we find that the earnings, the adjusted earnings of GAAP losers are actually as informative, even a little bit more informative than the reported adjusted earnings of profitable firms. So we're basically looking at a very dramatic improvement in the earnings relevance of GAAP losers, okay? Of course, you see a much bigger gap between GAAP losers and real losers, as GAAP losers now have very highly informative earnings, and the real losers don't experience much change from this adjustment, all right? So this basically confirms that regardless of what we do for real losers, even we allow them to capitalize intangibles, their earnings performance is pretty much still based on, is pretty much interpreted in the same way by investors. They still suffer economic loss, okay? All right, so that's the first test for earnings relevance. So in the next table, table 3, we use a different model. So instead of using adjusted earnings, we stick with reported earnings, and we expand our regression to include the intangibles adjustment that we included in adjusting reported earnings to adjusted earnings. So these are the capitalized and amortized R&D and capitalized SG&A, 1/3 of SG&A for both level and change. So it's a slightly different model, but still captures the same idea. The only difference is the adjusted earnings don't show up directly. Instead, we have reported earnings plus the amortized and capitalized R&D as well as SG&A. So with that change in our model, we continue to document the same effect coming from the adjustment for intangibles, okay? So if you look at the ERC earnings response coefficient, GAAP losers, now even for reported earnings, they have much higher ERC than real losers, as well as profitable firms, all right? And then we also provide some statistics for the intangible variables we included here. So it shows that for the GAAP losers, their intangibles are highly valuable, more valuable than real losers for sure, and in some cases as valuable as profitable firms. So that's another important finding. So no matter how you specify your regression model, as long as you include the capitalization and amortization of R&D and SG&A, by treating them as real economic assets instead of one period only expense, we show a dramatic improvement in the information content of earnings for GAAP losers, but not for real losers, okay? And in all cases, the reported losses of GAAP losers, the adjusted losses of GAAP losers become as informative as the reported earnings of profitable firms. So that's the bottom line from this test. In the next table, table 5, we expand this test to examine another well-known results from the prior literature, which shows that as the horizon of loss keeps growing, the information content, the relevance of reported earnings of loss firms would decline, okay? So we implement exactly the same idea by estimating this model, regression model for GAAP losers and real losers for 2 different loss horizons, 5 to 6 loss years, 7 or more loss years, okay? Many of you probably wonder how many firms actually go through this kind of prolonged loss experience. Actually, quite a few, okay? One example I can give you on top of my head is Amazon, all right? So after Amazon became a publicly traded company in late 90s, the company actually had 8 years, 32 quarters of consecutive history of reporting losses. So for 8 straight years, Amazon was reporting losses quarter after quarter. So Amazon would fall into this type of loss firms with 7 or more loss years, okay? So again, we run the regression for reported earnings and adjusted earnings. So for GAAP losers, again, when you run the regression using reported earnings, you see this results that has been documented by prior research. So when the loss horizon goes up, the earnings, the value relevance of earnings goes down from positive 0.14 to negative 0.018, quite a bit of drop, okay? However, when we run the regression with adjusted earnings for GAAP losers, you don't see any decrease in the earnings relevance, okay, of adjusted earnings. Actually, there's a little bit of increase over time, okay, from the 5 to 6 years to 7 more years, all right? So that's for GAAP losers. Again, as loss horizon goes up, the earnings relevance by using reported earnings actually does not go down, okay? For real losers, it's exactly the opposite for both cases. Whether we're using reported earnings or adjusted earnings, their earnings relevance goes down as loss horizon goes up, all right? So again, you see some very important differences between GAAP losers and real losers. GAAP losers are not subject to this problem of having a lower earnings relevance as loss horizon grows longer when we're using a more informative measure of adjusted earnings. Okay, so in this panel of table 5, we include the other version of a model with intangibles, adjustment for intangibles included, and we essentially document the same result, okay? Again, confirming that GAAP losers and real losers are fundamentally different. So that's the first test. In the second part of our paper, we focus on the liquidation option, okay? We have a closer focus here because we have seen from our previous result that intangibles play a very important role in bring the change to earnings relevance for GAAP losers. So clearly the intangible investment of GAAP losers versus real loser is the real difference maker in this particular context of examining earnings relevance. So because of this finding, we decide that in this part of the paper, we're gonna focus on examining the intangible investment of loss firms and profitable firms in 2 important areas, technology and human capital, all right? So the first area is technological innovation. So in this examination, we use a number of measures of technological innovation, including standard measures such as patent count and the patent citation intensity. We're talking about a forward citation, not backward citation. We are also using a relatively new measure of patent value developed by a paper by Kogan, 2017, Quarterly Review of Economics. It has been widely cited in the innovation literature. In addition, we also include our own measure of patent lead time in years, which is defined as the patent's application year relative to the starting year of significant patenting activities in the technological area of the patent. So for example, if you have a patent that is filed before 2 years before the start of significant patenting activity in the area of the patent, this patent would have a lead time of 2 years, and we code it as a negative number, -2, all right? How do we know if there's significant patenting activity in a given period? So we look at the data provided by US Patent Trademark Office in each specific patenting area, and every year, if there is at least 5 patent applications filed by all inventors, if this trend continues for another year, year 2, we count as the start of significant patenting activities. For the vast majority of technological patenting areas, 99% of the time, you see this inverted U shape of patenting activity over time. At the beginning of evolution in a given technological area, very little activity, a couple of patents on and off, until the area is starting to take off. And this happens when more and more firms are applying for patents. And that's when we define the beginning of significant patenting activity in this given area. So this is relatively new measure, patent lead time. So in addition to examining each measure individually, we consider all measures together for the purpose of inferring firms' innovation and the patenting strategies. For example, we look at whether firms respond to more competitive versus less competitive patenting environments with different focuses on patenting frequency, patent value, and the patent lead time. Different firms may pursue different strategies. So by looking at all these measures together, we can infer something about how firms respond to different patenting environments. I'm going to give you more details when I get to this part of our empirical test. All right. So in this test, as we have done in our earlier tests, we compare gap losers with real losers. That's one of the focuses of our study. And we also expand our comparison to look at whether gap losers are different from profitable firms that are matched on firm size, industry, year, total R&D spending, and R&D intensity, which is defined R&D expenditure as a percentage of sales. So this is something new we're bringing into this comparison in order to learn more about gap losers by using comparable profitable firms as a benchmark. Okay, so here's how results look like in a comparison for gap losers versus real losers. So we find that gap losers are much more successful than real losers. They receive more patents, their patents receive more citations going forward, and their patents are also more valuable, okay? All the differences are statistically significant. We also find that on average, the gap losers have a much larger patent lead time than real losers. So that both the mean and the median difference is more than 2 years, is about 2 years. So gap losers typically lead real losers by 2 years in filing their patents in a new technology area. So in some of the fast evolving and rapidly growing technology areas, 2 years of patent lead time is a huge deal. It's essentially a work or break variable for any company investing in their patents, okay? So the conclusion here is pretty clear. The gap losers are more dominant than real losers and more successful in their technological innovation, all right? And when we compare gap losers with comparable profitable firms, all right, keep in mind, these profitable firms are matched with gap losers by firm size, industry, year, total R&D expenditure, as well as R&D intensity measured as R&D expenditure as a percentage of sales, all right? So because of the matching procedure we use, we actually find that gap losers and matched profitable firms have nearly identical success in patenting frequency, as well as patent citation impact. The differences between these two firms, these two types of firms, are not statistically significant. However, we also find that gap losers actually, the patents they receive are more valuable than the patents received by matched profitable firms, all right? For the overall patent portfolio, for the median, the difference is statistically significant. And then when we measure this as average value per patent, we also see statistically significant differences between gap losers and profitable firms for both the mean and the median, all right? So although gap losers and profitable firms receive pretty much the same amount of patents, and their patents have the same citation impact, gap losers are more successful because their patents are more valuable. And when we look at patent lead time, we also see significant differences between gap losers and profitable firms. The difference here for both the mean and the median is more than 6 months, about 7 months. All right, 7 months of patenting lead time is not a trivial amount of difference. Again, in some fast evolving technology areas, it may define who has the first mover advantage. So it's quite significant from economic consideration. All right. So the conclusion from this comparison based on technological innovation is as follows. Based on evidence, we conclude that gap losers are more successful, far more successful than real losers in their technological innovation. By all standards, by all measures, we're including this comparison, gap losers are the winner here, okay? The comparison between matched gap losers and matched profitable firms show somewhat difference. Because of the matching procedure, although these two types of firms have very comparable size for their patent portfolio, as well as the overall citation impact, gap losers receive more valuable patents than profitable firms. And the gap losers also have more advantage in patent lead time. So these are the two key findings, the two key takeaways from this comparison, all right? Okay, so in the second test for intangible investment comparison, we focus on human capital, all right? We use a number of measures to capture the differences in human capital between different types of firms included in our test. So we include some of the conventional measures, such as employee inflows, outflows, which are also typically referred to as turnovers, as well as employee net addition. This is simply the difference between inflows and outflows, all right? And we deflate everything here by the average number of employee headcount during the year. So these measures are comparable across firms, okay? The data we're using for including these measures come from a relatively new data source. The name of the data vendor is Revealing Labs. I have seen some recent paper using this interesting database to test all sorts of hypotheses involving human capital. So we're using this database as well. In addition to these conventional measures of employee inflows, outflows, and net additions, we're also including employee productivity measures. And here we're looking at not just the level, but also more importantly, the change in sales per employee and its association with employee inflows and net addition over a given period of time, okay? So we're looking at whether firms experience any increase or decrease in this very important measure of employee productivity when they expand their workforce to hire more employees, to retain more employees. So if there's a positive association, that means firms are successful when they expand their workforce to include more employees. They also experience improvement in employee productivity measured by sales per employee, all right? In addition to that, we also include employee expense measures such as change in SG&A expense, either as a percentage of sales or SG&A expense per employee, all right? So this is also going to give us some additional insights into the relationship between employee turnover and the financial impact of employee turnover on the firm, all right? Again, we don't just examine these measures individually. Instead, we look at them all together. And this would allow us to learn something about whether or not a firm has successful human capital strategies that allow them to prioritize the hiring and retention of highly productive employees, and also the termination of unproductive employees, and also control employee-related expenses. So if a firm has a strategy working like this in human capital, this is definitely going to help them increase the return on their investment in human capital because they're able to increase employee productivity while controlling employee-related costs. So again, we compare gap losers with all real losers. We also compare gap losers with profitable firms matched on firm size, by industry, by year and average employee headcount. We do this to make sure that we come up with a sample of gap losers and profitable firms that can give us an apple-to-apple comparison. Okay, so before I present the details of my empirical results here, let me see if I can respond to any of the questions here. Okay, all right, you can see that. All right. So here's how our results look like when we compare gap losers with real losers. So for all the firms covered by this relatively new database, we see quite a few very interesting differences between gap losers and real losers. As you can see here that these two types of firms have nearly identical amount of employee inflows, which basically means that they bring pretty much the same number of employees on an annual basis, okay? The mean and median differences are essentially zero, so they're identical. However, if you look at the outflow numbers here, the real losers actually experience a much higher employee turnover. So they bring the same number of people, but they lose more. So at the end, gap losers are more successful in employee retention, okay? By looking at the amount of net employee addition, mean and median, you can see that the gap losers in employee retention, they are twice as successful as real losers, okay? The mean and median differences are statistically significant and economically meaningful, okay? So 0.03 as mean basically means there's a difference of 3 employees per 100 employees, okay? The median difference is almost 2. So it's economically meaningful as well, okay? So that's the difference between gap losers and real losers. So gap losers are more successful in employee retention. So that's the first step. And when we compare gap losers with matched profitable firms, we also see a number of interesting differences, okay? First of all, gap losers are more successful in hiring new employees. They bring more new employees. The mean and median differences here are statistically significant. However, the gap losers also lose more employees than profitable firms, okay? They hire more, they also lose a lot. So at the end, their employee addition, net employee addition is somewhat lower than the level for matched profitable firms, okay? The difference in mean is actually not statistically significant. We're both mostly looking at a median, so there is a difference of negative 0.008. Because of the way we deflate this measure, it basically means that if you have a firm with 100 employees, the difference in net employee addition between gap losers and profitable firms is less than 1 employee. So what does that mean? Well, it's probably not economically significant. So with employee headcount of 100, you don't even see a difference of 1 at the end after you go through the employee inflows and outflows, all right? So that doesn't look like a very economically significant difference. So based on this propensity score matching procedure, we can pretty much conclude that we don't have a huge differences in the area of net employee addition between gap losers and profitable firms, all right? So they look pretty similar. However,
can I have a question?
Yeah, go ahead.
Do you have any sense on what made earnings response coefficient of the gap losers beat the ERC of the profitable firms? Because as you can see here, there's no difference in terms of the human capital investment.
Yeah. I agree with you. This is an excellent question. I'm really glad you see the difference and ask me about that. So let me just make sure everybody understands the question. If I go back to the early results for earnings response coefficients, as you can see from early results, in some of our tests, we actually find that the earnings response coefficients for gap losers are somewhat higher than the earnings response coefficients for profitable firms. Why is that? Well, some of the tests we did earlier are actually not included in this version of the paper. They could shed some light on why this difference exists. Now, remember, we're focusing on loss firms. So we're classifying loss firms into two categories, gap loser versus real loser. However, we're not doing the same thing to process profitable firms, okay? More broadly, if you think about the effect of investment in intangibles, the decision. Somebody asked me earlier about how managers may make this decision, managerial behavior. They work differently for loss firms versus profitable firms. For profitable firms, if you agree with this motivation of real earnings management, as shown by prior research, some profitable firms actually become profitable because they decide to spend less on intangibles. So before you make this decision, if the manager believes that without this manipulation, the firm will not be able to report profit, then the easiest way to go is to spend less during the last couple of weeks of a quarter. Spend less on your R&D, spend less on your advertising, and immediately it's going to boost your profit. All right. So some of the profitable firms in our sample, there's no doubt they did this trick in order to become profitable. As I mentioned in some of the earlier tasks we have for this project, which are not included here, we actually took closer look at this type of behavior and to find out whether or not there's a difference between profitable firms, the firms reporting profit. Actually, we saw some. And after we exclude firms that decided to spend less on intangibles relative to the industry peers in order to become profitable, the results for the non-manipulating profitable firms are stronger. In other words, the ERCs for the non-manipulating profitable firms are actually higher, and they're much closer to the ERC of the gap losers we see here. So that would be my answer. The profitable firms have not been adjusted. If we go ahead with this adjustment, some of our results would be more comparable.
What about, if I recall correct, in your table comparing the patent performance,
yeah,
the value of the patent of the gap losers looks like a little bit higher than profitable firms. So can you use that as an additional explanatory variable for that difference in ERC?
That's a good idea. We actually haven't thought about it. It's something we can go back by using this matched sample to test any difference in ERC and see if that's exactly driving force. It's a very good idea. Yeah, I agree with you. That may be something else we can do as a follow-up test. Actually, there is something I forgot to mention about this part of a test comparing gap losers with profitable firms. So I mentioned earlier that we're also interested in learning something about the innovation and the patenting strategy followed by different firms. So here for the overall comparison, we see that gap losers have more valuable patents than profitable firms. And they also have a significant advantage in patent lead time. So in some follow-up tests, which are reported in the paper without any table or statistics, we actually look at the differences between two types of patenting environment. So let's say you file patents in a very competitive area with more than 100, at least 100 patents filed by all firms from all industry, from all countries in a given year. So that's something we define as a competitive patenting market versus a non-competitive patenting market. So we break down our sample into these two types of patenting markets and try to see if there's any difference between gap losers and profitable firms. We actually saw some very interesting differences. So for example, in the competitive patenting markets with a lot of firms, including some of the industry leaders, filing lots of patents every year, the gap losers behave differently than profitable firms, okay? The gap losers take advantage of the high activity level in this area to file more patents than profitable firms, okay? However, each patent they fire actually is less valuable. It's like they're taking shots all the time, although most of the shots are smaller shots, all right? So they have an advantage in frequency, not in value, okay? However, the gap losers also have more advantage than profitable firms in patent lead time. In other words, they are not just making more shots, they're making shots earlier, okay? Even though most of their shots are smaller shots with less value. So essentially, this innovation strategy emphasizing efficiency and first mover advantage allow the gap losers to achieve a higher, significantly higher overall patent value than profitable firms. The frequency advantage dominates the disadvantage, more than compensate the disadvantage in patent value on individual patent basis. So that's the difference. On the other hand, yeah, go ahead.
I was more interested in what I see here. I'm looking at the panel B, average value per patent.
Yeah.
So I'm more interested in this economic value of a patent rather than scientific value, frequency or citations.
Yeah, that's the commercial value. Yeah,
Yeah.
You're right. Yeah. So you're absolutely right. It's hard to translate, the patent frequency and difference in citation into commercial value. But that's why we're using this relatively new measure of patent value developed by Kogan et al. 2017, because it gives us a direct idea about how much is the value of each individual patent. Okay. So a follow-up question is this really economically significant? I believe in the paper, in one of the footnotes, I provided some calibration to put everything into context. And I think the difference here would translate into something like 3% of overall firm value. It's not huge, but it's 3%, which is typically economically significant. All right. So that's basically what we're looking at. Okay, so to finish my explanation about what else we discovered here, in the less competitive patenting market, the gap losers follow different strategy. They're not making more shots. They're actually targeting more valuable patents. So they obtain patents with higher value, but they patent less frequently than profitable firms. So these firms, they're actually quite nimble. They respond to different patenting environments differently than profitable firms. And this kind of strategy allows them to have more valuable patents. So that's basically the additional insights we gained from this examination. Okay. All right. So let me go back to the second half of my human capital comparison. Okay. So after documenting the very close results between gap losers and matched profitable firms, we then took the next step to look at, first of all, employee productivity, all right, for gap losers and profitable firms. And this is how our approach works, okay? We don't just measure overall employee productivity. No, that's not powerful enough. Instead, we first divide all firms, gap losers, for example, into 3 groups, tercels, based on either employee inflows or net additions, okay? So the top tercel here captures firms with the highest number of inflows and the highest number of net additions, okay? And the bottom tercel captures firms with the lowest number of inflows and the lowest number of net additions. For each tercel, we report the change in employee productivity measured by sales per employee, okay? The change in the same year when employee turnover is happening, okay? So as you can see from this table, for firms with the highest amount of inflows and net additions, we also see the highest increase in employee productivity measured by sales per employee, okay? So what does the number mean? 0.015, okay? Because employee productivity is measured by sales per employee, and the sales are measured by millions of dollars. This number, 0.015, would actually translate into $15,000, okay? We're talking about increase in sales per employee by $15,000. Here, $14,000. Okay, and for firms with lower employee inflows and net flows, we have much smaller increase and improvement in employee productivity. So if we summarize the results here by using correlation coefficients, we find very positive and significant correlation coefficients between employee turnover and increases in sales per employee productivity, okay, during the same year, year T. And then in this part of a test, we also expand the time horizon to look at employee turnover in year T versus increases in employee productivity in year T plus 1. Again, the same pattern, still positive, correlation coefficients. And then we also expand the horizon further to look at employee turnover in year T minus 1 versus changes in sales per employee in year T plus 1. Again, positive association for gap losers. Okay, the same tests don't show any positive association for profitable firms. So what does the difference mean? The difference basically tells us that gap losers are able to leverage employee turnovers to increase employee productivity. They're much more successful in doing so than profitable firms with the same characteristics, same industry, same year, same size measured by employee headcount. So the human capital strategy for gap losers is working much better than profitable firms. So that's the story for employee productivity, okay? So here in table D, we move to compare employee-related expense, again, the change, okay? So we skip the tercile distribution statistic. Instead, we focus on the association. And for gap losers, we find significantly negative association between employee turnover and the change in employee expenses across different time horizons. Always negative, always statistically significant. Same thing is not true for profitable firms. Inconsistent, very weak results, except for this one. So what do we learn from here? So the results of this this test for employee-related expense basically indicates that gap losers are also able to take advantage of employee turnover to reduce employee-related expenses. They're much more successful in doing so than matched profitable firms. That's a huge advantage. On the one hand, gap losers are able to increase employee productivity. On the other hand, they're able to better control employee expenses. That's really a very strong advantage, all right? And now here we reported some summary statistics to give you some indication about the magnitude of the change we're talking about for each type of firms. For here, the mean change in employee expense, SG&A expense per employee the current year, if you translate this into dollar amount, it's about $8,000, which per employee, that's not trivial, all right? That's the current year. The next year, it translates into an even further saving of $29,000, okay? Not much going on for profitable firms. So the human capital strategy for gap losers is much more successful, no matter how you look at it. They're most successful in attracting new employees, in retaining highly productive employees, and in controlling employee-related expenses, all right? So in the last part of this task, we want to add some more power and rigor to this task by examining firms that switch from, for example, real loss to gap loss, or going the other way around, switching from gap loss to real loss. We also include a firm switching from gap loss to profit, which in our mind is much less meaningful improvement because gap loss basically comes with economic profit, all right? So this type of change specification allows us to increase the power and rigor of our test. When we compare these two types of firms with that switch their profitability status, we see a number of interesting differences. For firms switching from real loss to gap loss, that's the big deal. We see a significant improvement in employee addition, in sales per employees, as well as reduction in SG&A expenses, employee-related expense over different time horizon. Okay, not just the current year, 1 year ahead as well. The other group here, not much. They're significantly behind the first group. Okay, the third group here, it's much more muted. They experience some improvement, but not nearly as much as the first group, which has a much more meaningful improvement from real loss to GAAP loss. So that is really the part of our test that actually gives us more confidence that what we capture so far is quite robust. All right, so that's the last step in our examination of human capital. So in the last part of a paper, we examine the future performance of different types of loss firms. We focus on the likelihood of future decline, the probability of loss reversal, as well as future stock performance. Okay, so the first test, probability of future decline. Well, how do we define decline? Decline firms are defined as delisted firms, firms in liquidation, as well as firms experiencing worsening loss situation with growing loss amount. Everybody else is defined as non-declining firm. So with that very simple classification, when we look at a difference between GAAP losers and real losers, every single year across a sample period, GAAP losers have a much smaller likelihood of decline than real losers. All right, so here the last two bars give the average across all sample years. Okay, so the difference here is actually quite large. So that's the univariate comparison. We also test a model, multivariate model that includes this indicator variable, GAAP losers and versus real losers, as well as a bunch of control variables for firm characteristics and important activities in investing, financing, and operating area. All right, so everything we can think of that can have some sort of impact on the future likelihood of decline or non-decline. Again, results are very strong. GAAP losers have a much smaller probability of future decline than real losers. All right, and then for loss reversal, we look at 3 different horizons: 1 year, 3 years, 5 years down the road. For the 3-year and 5-year horizon, we look at individual earnings for each year, as well as combined earnings for 3 years and 5 years, respectively. So this is the univariate statistic. As you can see here, that GAAP losers are twice as likely as real losers to reverse loss in future, no matter what time horizon you look at, no matter what definition of loss reversal you're using. So they're twice as likely to have loss reversal than real losers. Again, we include a multivariate regression here by using a lot of controls, and we document the same result here. Very, very strong result, indicating that GAAP losers are more likely to experience loss reversal than real losers in the future. Okay, so here comes our last test for firm performance in the future. So we look at future stock performance. We don't just look at average abnormal returns over the entire sample period. That does not cover every possible scenario. Instead, we examine the growth of $1 invested in GAAP losers, real losers, and even profitable firms over time, and see how much change to this $1 investment. Okay, and we estimate this future growth of $1 investment over time by using the annual value weighted portfolio returns for portfolios reassembled each year when we have updated accounting information. So the basic idea works as follows. For example, if we invest $1 in a given portfolio, whether it's GAAP loser, real loser, or profitable firm, works the same way. So we invest $1 in the portfolio of 1980. Okay, for some reason, the annual weighted average return of this portfolio comes out to be 10%. So that means we're going to gain 10 cents as the investment return, and then we liquidate the portfolio when accounting information for 1981 becomes available, and we use the total proceeds, the principal plus return, to invest in the next portfolio for the next year, and this keeps going. All right, so that's what we do. And here's how the results look like. When we implement this methodology for the 3 samples of our firms here, not a surprise, the profitable firms actually do extremely well. We know this must be the case because the profitable firms in the sample include some of the most successful firms in each decade, like General Electric in the 1980s, Microsoft in the 1990s, and Apple in the 2000s. So that's why this portfolio always has the highest return. All right. For gap losers versus real losers, the difference here is quite substantial. All right. For every $3.22 of total value created by real losers, the gap losers actually create $38.35. Quite a bit of difference. Okay. Although the profitable firms dominate gap losers, when we break down our sample into 2 periods, from 1980 to 96 versus 97 to 2017, you probably want to ask me why 2017. I will tell you in the next slide. It's not a random choice at all. So when we do this, we see that profitable firms dominate gap losers in the first half of a sample. All right, $8.50 versus $12.81. However, in the second half of a sample, gap losers actually do a little bit better than profitable firms, $4.48 than $4.15. Okay, so the next slide explains to you why I choose 1997 as the year for dividing our sample. It's not a random choice because economists who track the investment trend over time documented that in 1997, for the first time, the intangible investment rate in the US private economy finally and permanently exceeds the investment rate for tangible investment for the first time. And after that, there's no way going back, and intangible investment has been increasing and the tangible investment has been generally decreasing. So 1997 is a very interesting year to look at. So that's why I divided by sample using this year. And if you look at the first half from 80 to 96, every single year, no matter when we enter the portfolio construction process, no matter how we start the comparison, the profitable firms always do better than gap losers, no exception. All right. So that was a totally different period of time. However, starting from 97, with the exception of only 1 year, 1999, which is affected by the tech bubble and then the bursting of the tech bubble. With that one single exception, every single year, if you start a portfolio by investing in gap losers and profitable firms, you would have done better with gap losers than profitable firms every single year. Even at the end of the sample period, the difference is still quite visible. All right. Okay, so that's the overall comparison. In the last bar here, I have a match sample design again. So big disclaimer here, we're not trying to examine any trading strategy. We're not trying to talk about abnormal returns. We're not trying to detect the source of abnormal returns, risk versus market mispricing. We're not doing that. We're simply using future stock return as a performance measure for future firm performance. That's all, okay? So when we do the match sample design, we match gap losers with profitable firms by firm size, by book to market, by industry, and by year. So when we do that across the entire sample period of 80s to 2017, we see that when we have apple to apple comparison, gap losers actually do significantly better than profitable firms. For profitable firms have a total value, earn a total value of $7.65 versus $20.82 for gap losers. Quite a bit of difference, okay? The real losers, they're not even close. They're not even close, okay? So this comparison of future stock performance confirms our earlier conclusion that the gap losers have much stronger future performance than real losers, as well as comparable profitable firms. Actually, they have been doing better than profitable firms for the last 20 years. So that's the last tab. So based on our results, we offer the following conclusions. Overall results show that gap losses caused by the immediate expensing of firms' internally generated intangible investments are fundamentally different from real losses that occur in respective of firms' intangible investment. Our results show that contrary to the widely held view that losses are irrelevant, we find that gap losses are highly informative, and they are as informative as the profits, okay? We also find that value relevance of reported earnings for gap losers does not decrease with the persistence of gap losses. When you have more years of gap losses, your earnings relevance actually does not go down, all right? More importantly, when we dive into the intangible investment of different types of firms, our results consistently show that gap losers actually have more successful investment in their innovation and intangible assets. They develop more valuable patents, and they're more successful in creating value from human capital than real losers, as well as profitable firms. So essentially, their intangible investment become a potent source of shareholder value for gap losers, all right? When we look at a future firm performance, we find that gap losers are less likely to decline in future, more likely to reverse loss in future, and they have better stock performance in future than real losers, as well as profitable firms. So what is the punchline? So taken together, all results indicate that the standard accounting reports for gap losers seriously distort their performance and their intrinsic value. These are highly dynamic and highly innovative firms. They're really behind the driving force responsible for the intangibles revolution economy today. Unfortunately, the accounting reports consistently show losses for these firms. It's really a serious distortion. That's what our results have documented so far. All right. So that's the end of my presentation. I would like to leave some time for questions and answers. Let me go back to the history of chats. Okay, I see Chanchi has been responding to some of our participants. Thank you very much, Chanchi.
Thank you very much, dear Professor Feng, for your contribution and your effort. It's really an excellent presentation. Thank you very much. Now, if anyone have any questions, you can open your mic and ask your question.
I wanted to ask one question.
Yeah, go ahead.
Professor, you said that the turnover, employee turnover is related to whether it's a real loser or a gap loser. So there are also various other measures why people or employees, they quit their jobs. So did you consider that?
It's a good point. So people leave firms for different reasons. Sometimes it's voluntary departure. Sometimes it's involuntary termination. I don't think our current data allows us to tell the difference, but I think you're right that there should be differences in terms of their implications for the human, capital, human resource management strategies. Unfortunately, our data, I don't think our data allows us to do that. Maybe in the future, when the database expands to include some more indicators for why employees leave, that may be something we can look into. It's a very good area.
It's Finn Kinsadal from Norway. Understand you're somewhat skeptical to the current accounting rules. Does this study suggest that you want to capitalize R&D and test them for impairment?
I think I'm aware of at least one study. It doesn't have the same empirical research design because right now it's not done under the US GAAP. It's a paper by two researchers. There's a third co-author, but I remember two of them from Harvard Business School, Krish Palapun and Paul Healy, I think in either late 90s or early 2000. They performed an experimental study using simulation based on the setting of pharmaceutical and biotechnology firms. So in this setting, they allow firms to capitalize R&D by using some of the real scenarios from the pharmaceutical industry. And then they also require firms to run impairment tests. Again, they use the real statistical distributions from the pharmaceutical industry to run their simulation. Their results actually strongly indicate that a capitalization plus impairment regime is better than expensing regime for investors. And also they look at some of the earnings management issues, and conclusion is quite favorable. The capitalization plus impairment regime is a better choice. That's the only experimental study I'm aware of. I know under the setting of IFS, there are a couple of studies looking into the benefits of capitalization versus expensing. My co-author, Brooklev, has a paper co-authored with somebody else. It was published in Review of Accounting Studies a couple of years ago. They used the data from Israel to look at this issue. They have very unique setting because it's like a real life experiment. Some firms follows one regime and other firms follow an alternative regime. And they also document consistent results indicating that the capitalization plus impairment regime actually is a better system. So that's the evidence I'm aware of.
Yeah. I thank you very much. I also ask about your personal opinion, and if you want to answer that.
My personal opinion, you know, I spent a lot of time with Brooklev in doing research, and we wrote a book a couple of years ago, and my personal opinion is pretty clear. I think, number one, the current regime is not working. All right, as the evidence in this paper has shown, it's really a problem when you have so many firms reporting losses. Accounting is losing credibility. There's no doubt about that. Number two, when the current system is not working, the question is not about whether or not we should keep it. The question is about how to improve it. So capitalization is a viable option. It's certainly a viable option. All right. Without taking this step, no matter what we do, for example, improving disclosure, we're not fixing the problem with earnings. Earnings are no longer informative. I have written some papers on that, again, with Brooklev. And even the balance sheet information, book value of equity, is becoming more and more problematic. The early example I quoted, value investing, clearly shows that investors have suffered when they follow book value of equity to make their investment decisions. It used to work pretty well, not anymore. That's why so many value investing funds, large and well-known value investing funds, have closed in recent years. So my personal opinion is, yes, we have to do it.
Thank you.
Are there another question? If anyone have any questions, you can open your mic and ask your question. If anyone have any questions, you can open your mic and ask your question. Thank you very much, dear Professor Feng Gu, for your contribution and your effort. It's really an excellent presentation. Thank you very much. So all that remains for me to say thank you everyone that joined us, and I thank you very much for taking the time out to present to us today, dear Professor Feng. It's been really appreciated. Thank you very much.
Thank you, Mohammed. Thank you for this opportunity. I appreciate everybody's comments and suggestions. It has been a wonderful experience. I hope to see you again in future.
Yeah. You are very welcome. And I hope to see you soon in Egypt, dear Prof.
Okay, I will. Thank you very much.